Hey Bowtie Nation, Joseph Hogue here with 7 stocks already blasting off on the news, and Nvidia adding rocket fuel to go higher. One of these stocks jumped 27% the day Nvidia's latest 13F dropped. It's now up almost 300% in just 2 months since April. I'm going to reveal the top stocks Nvidia is buying right now. Not rumors, not guesses, but straight from SEC disclosures. The kind of insider moves that tell you exactly where to follow the money. I'm going to show you how much Nvidia has invested in each, why you should be buying as well, and what to watch for. But don't skip out early because the final stock on the list isn't just my favorite. It's the one I'm buying with the highest return potential. First up, CoreWeave, ticker CRWV, was the big news when Nvidia released its updated 13F filing, sending the stock up as much as 27% on the day. And it hasn't slowed down yet, now up almost 300% since the April IPO. That kind of a run, especially after its IPO, would normally make me hesitate on a stock like this because we see it all the time. A new stock bolts out of the gate as investors get excited, but then crashes back into reality over the rest of the year. But nation growth here and the company's competitive advantages has me taking a second look and buying in here even at this price. CoreWeave is a cloud infrastructure company purpose-built to support artificial intelligence workloads at massive scale. Unlike traditional cloud providers, CoreWeave has optimized its entire stack from hardware to software to serve the most compute-intensive applications, particularly those using machine learning, generative AI, and large language models. CoreWeave's key competitive advantage lies in its AI-specific architecture and rapid deployment capability. It operates 33 data centers around the world with over 420 megawatts of active power, contracted and purpose-designed for GPU-intensive AI workloads. And CoreWeave also benefits from a unique contract-backed revenue model, where customer commitments are secured before capital expenditure. This success-based investment structure reduces that financial risk and improves capital efficiency. Revenue here has grown 11-fold in the last 2 years and is expected up 160% this year to $5 billion and to almost $12 billion next year. It's that kind of growth that justifies this massive run in the shares lately. Just applying those forecasts to the $68 billion market cap, if it hits that $5 billion in sales this year, that's a price to sales of 13 times, which isn't cheap, but if it even comes close to that $12 billion in sales next year, that is a price to sales of just 6 times, which would make it a steal. Nvidia's investment of 24 million shares worth $3.7 billion in CoreWeave is a strategic bet on that vertical integration of its GPU ecosystem. By backing CoreWeave, Nvidia ensures long-term demand for its GPUs, secures deployment partners for its latest hardware, and gains influence over how that next-gen AI models are trained and deployed. And this strategy is something you're going to see in almost all of Nvidia's investments, furthering that relationship with key buyers in the GPU chip supply system and nurturing growth in those AI use cases. It's just one of the reasons a company like Nvidia might invest in another, and why these 13F reports are so important. The Securities and Exchange Commission, the SEC, requires these reports every 3 months from those large institutional investors or companies to show their investments in publicly traded stocks. That disclosure is meant to help the SEC head off any possible stock price manipulation by hedge funds and other big money players, but it can also be used by investors to jump in on those investments ahead of an acquisition or just a bump in the price. You can always find these 13F filings by going to the SEC Edgar database online and then searching for the company name, and click through where you see the most recent 13F report for a list of those investments. I want to get back to our list of Nvidia stocks, so I'm going to outline the other reasons a company invests in another and some important risks to watch out for later. Shares of Chinese autonomous tech WeRide, ticker WRD, jumped 159% on the news in February that Nvidia had picked up 1.7 million shares of the company. And while the stock has come down since, it's still a $15 million stake and a 0.6% ownership of the company. Since its inception in 2017, WeRide has expanded operations into 30 cities across 7 countries, though still mostly in China. The company brands itself as a first mover in that autonomous driving market, with less expensive cars than others in the space and reaching that level 4 autonomy, very near that self-driving level 5 that we're trying to get to. Revenue exploded from just 18 million Chinese yuan in 2020 to over $500 million in 2022, which is still only about 72 million USD, but has since fallen back to 365 million Chinese yuan, or about $50 million over the last 12 months. Of course, the few analysts covering the stock only see rainbows and unicorns, with forecasted sales up 132% this year and 188% next to 2.4 billion Chinese yuan, about 338 million. But the fundamentals here are god-awful, and even the crash since February, the stock trades expensively at 50 times price to sales ratio. But none of this probably matters to Nvidia because I think it's an olive branch to China. Nvidia has been all but shut out of China with new export restrictions on its chips, and sales have fallen from 25% to 15% of its total revenue. And still, that's as much as $30 billion a year, and a segment Nvidia desperately wants to keep alive if restrictions ever get lifted, So it would make sense that it would invest in a Chinese AI company to nurture that ecosystem in the country. That we write investment highlights the idea of different reasons a company buys shares in another, and could mean a difference in returns for investors following those 13F reports. One reason, as in the case of Nvidia buying shares of ARM Holdings, is getting a say in a major supplier. ARM licenses the architecture that goes into semiconductor chips, so it's a critical component for not just Nvidia, also its competitors like Intel and AMD. Now, Nvidia was blocked by the FTC from buying the company outright, but an investment gives it a spot at the table. Now, another reason, a company may also be interested in a future takeover of another company and want to get its foot in the door with a large block of shares to ward off any rival buyers. This might be the case with Amazon and its ownership of Air Transport Group, with nearly a fifth of the company's shares. Nebius Group, ticker NBIS, didn't get quite the same bump when Nvidia reported its investment of almost 1.2 million shares, worth $63 million, but has surged lately with the stock up 271% over the last year. While Nebius is hooked into the fastest growing themes in AI, feels like they're trying to be everything to everyone here. Besides the core cloud platform, the company is also building data centers, developing edtech platforms, and autonomous driving technology. Now, that scope of business is similar to what Amazon and Alphabet are already doing, but then again, Alphabet has $72 billion in free cash flow that it needs to invest, versus Nebius, which reported negative free cash flow of $374 million in the last fiscal year. So while Nebius is targeting an absolutely giant $260 billion market for cloud and GPUs, along with another $150 billion markets in its other segments, I wonder if it can actually be competitive in any of them if it tries doing everything at once. Now, given that, sales are expected to keep surging, approaching $1.3 billion next year, but profitability is still a ways off, and the stock is getting extremely expensive at 71 times sales, from just 13x multiple when we highlighted it last February. So here I would go with one of the more focused players in the cloud, like CoreWeave. Nvidia is holding on to Recursion Pharmaceuticals, ticker RXRX, down 37% over the last year, though it has rebounded some recently. But with Nvidia holding on to its 7.7 million shares, worth about 3.2% ownership, and worth $42 million. And this one has been disappointing because there is so much opportunity here. Recursion could revolutionize drug discovery through its language model workflow engine, performing complex drug discovery tasks using a natural language interface. It's doing this by running experiments through its purpose-built AI models on massive datasets, enabling it to screen and find the compounds that won't work, basically just to fail faster, so it spends less time and money developing the drugs that will work. Big pharma companies like Merck and Eli Lilly are facing a patent cliff amounting to nearly $200 billion in lost revenue, while also pulling back on their own research spending to find new drugs. Through the use of AI, Recursion could dramatically lower costs for drug development, an advantage that would be worth tens of billions of dollars to these big pharma companies. The company has 6 programs in pipeline trials for 7 indications, 4 of which are in phase 2 and expecting results within the next 2 quarters. It's inked partnerships with major drug makers like Roche and Bayer, but like most biotech stocks, the potential is there. But it comes in fits and starts when the company announces a breakthrough or FDA approval or a deal with another company. Revenue is expected up 29% this year, followed by 46% next, but can turn fast on that one major discovery. With Recursion's track record, though, instead of just investing in the stock, I want to protect myself with an option strategy here, the covered call strategy, one of my favorites for creating income and lowering risk in a stock. I can go here to the options available, and you can use this on a monthly basis for income, but I like to use the longer dated options, so we're going to use the ones expiring January 2027, about 18 months from now. With the stock at $5.61 each, I can sell these call options with the $10 strike price and receive $1.75 per share immediately. This gives another investor the right to buy the shares from me over that 18 months for $10 each, but also gives me that cash now and lowers my cost. In fact, accounting for that $1.75 I collect, I really only pay $3.86 for the shares of Recursion, and if the stock goes to that $10 each over the next year and a half, I'll have made a 159% return. But then the beauty of this strategy, even if the shares don't jump to that $10 each, I will still have made a 31% cash return from selling those options, and I'm going to keep the stock for further gains. That is just one example of how I use options. I know a lot of you aren't using options yet, and I gotta ask why. I asked the Bowtie Nation how they've been using our options investing course and was blown away with the responses. George made over $26,000 buying call options on SMCI, a 315% return in just 2 weeks. Justin made a 380% return on a call option strategy in 1 week. And longtime Bowtie brother Chad generated over $10,000 in income this month across 5 stocks, from Amazon to Alibaba and Nvidia. To help you get started, I'm relaunching our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly how much you can make. And right now, I'm relaunching the course at a 38% discount. Save $150 off. You'll get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. Now, that $150 launch discount is only available with the coupon code I'll leave in the description below, so look for that link or just scan the QR code here. Back to our list, and Applied Digital, ticker APLD, which has made new all-time highs this month, taking Nvidia's 7.7 million share position to $107 million, a 3.5% ownership of the company. Applied is at the heart of the next wave in AI, the data center build-out. The company develops, builds, and operates data centers and cloud infrastructure with a focus on the specific needs for accelerated computing for artificial intelligence. And here, a really interesting development has become the transition from that blockchain data centers to those needed for AI operations. As the Bitcoin halvings continue and profitability for mining decreases, we're seeing those data centers repurposed for high-performance computing, and I think Applied is positioned perfectly to do that with its existing blockchain infrastructure. Sales for the company are expected to grow by 33% this year, but to hit a brick wall next year at just 3% growth. And the problem is the margins are so low, the company doesn't seem to be getting anywhere on its earnings, expected to post a 55 cents per share loss next year. At a price-to-sales ratio of 11 times, the stock isn't terribly expensive on this year's sales growth, but if it can't continue that same pace of growth, and I'm afraid here that the realization that this one may never be profitable is going to hit investors with that harsh wake-up someday soon. The largest company by far in Nvidia's investments is ARM Holdings, ticker ARM, with Nvidia owns 1.1 million shares, worth $154 million. ARM designs microprocessor architecture, the blueprint for semiconductor chips, which are the brains of any electronic device. It then licenses these blueprints out to chip makers like Nvidia, AMD, and Intel to create their semiconductors, so it is a critical piece of the chip supply system. And seeing the potential in this, Nvidia actually tried to acquire the entire company in 2020, reaching an agreement with SoftBank to buy ARM for $40 billion before the FTC stepped in to stop the acquisition. Nvidia still wanted a foothold on that supplier though, so it picked up the 1.9 million shares, which have more than doubled since its IPO. And this is more of a strategic investment for the chipmaker. Nvidia still wants a seat at the table with ARM against its competitors, and in fact, we see other big tech companies, including Alphabet, with a similar position. Now, this next stock was in Nvidia's portfolio last year before it sold its shares, and could be Jensen Huang's one biggest mistake, selling too early. But as big as Nvidia's $4.2 billion portfolio here is, it is nothing compared to the $105 billion Amazon has invested in just 5 stocks. So make sure you watch the video linked here in the corner next. Amazon's top 5 investments. Now, for those of you in the nation, SoundHound AI, ticker SOUN, will be no great shock as the stock I'm buying above all the rest here. Nvidia actually did own 1.7 million shares of this AI voice assistant leader for a 1.5% ownership in the company as recently as November of last year. But by the February update, had sold out of its position. And I totally get it. Selling in December when the stock skyrocketed up to $25 a share, way past any kind of fair value, was the smart thing to do. In fact, I had 13,000 shares last year at an average cost of $5 a share accumulated through the year, and took profits of most of that on December and January myself. But when the shares came back down, I jumped back in with another 10,000 shares and a cost basis of $8.83 each, because this stock is going back up to that $25 peak and beyond. Nation, agentic AI is going to be the first way artificial intelligence changes our lives, and SoundHound is the leader in agentic voice assistants, a market it estimates as large as $160 billion, but I think is even higher than that, and dwarfs the company's $85 million in last year's revenue. Besides its use in cars across Europe, SoundHound is now expanding into drive-through ordering, partnering with fast food chains so you can order from your car on the way. No more waiting. Revenue is expected to nearly double again this year to $160 million. I think next year's forecast for 25% growth is going to be revised upwards when we see some of the company's projects really build momentum. Now, the shares aren't cheap here at a price of 28 times this year's expected sales, so that market cap divided by the $160 million forecasted revenue. But I would still be slowly accumulating shares here so you get that exposure. Get your $150 discount on our options investing course only with the special coupon code in the link below. You'll get the strategy finder so you know which of the 29 strategies to use, and the options calculator to show you exactly how much you can make. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.